Hello everyone, my name is John Locke and I'd like to welcome you to the Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We are not broker dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation we are covering hypothetical computer simulated trades. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke from lockeinyoursuccess.com. That's L-O-C-K-E in yoursuccess.com. I'm a trading performance and wealth and success coach with Lock in Your Success LLC. And myself and my team of mentors are here to help you win in the markets and in life as well. And today I'm here to take you into the realm of something called high probability options trading. Now, high probability options trading is where we utilize option strategies to make money through the passage of time rather than depending solely on price movement in order to be profitable. Meaning that we can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean that we win much more often than most directional traders are going to win. And certainly with a lot less trouble than trying to predict what the market's going to do. The trading strategy we're going to be covering today is called an X4 version 17. Now, the X4 version 17 is a trading strategy that I developed. It's a high probability, positive theta, broken wing butterfly strategy that we use on the SPX. The strategy requires a minimum of $3,500 per trade. The example size we're going to be covering today is going to be a $35,000 planned capital trade. The trading strategy does not have a profit target, but in a good month in general, I would expect to return about 10% of my planned capital, and it has an exit loss trigger of 7.1% of planned capital. In this case, it's going to be $2,500. Okay, so what you're looking at here is something called analytical software, and it's from a company called OptionNet Explorer. And what this software does is it gives you an analytical graph that kind of helps you understand your position. So over here, we have the date, we have the asset that we're trading. Within these columns are various expirations that options have for the asset. So we're trading the SPX, we're trading the July 16th, 2021 expiration options. They are 77 days to expiration. Our call options are on the top, our put options are on the bottom. For this strategy, we're going to use all put options. We're going to enter something called a broken wing butterfly with a short strike 17 to 27 points under the money. So if we take a look at our asset price, it's 41.8364. If we look for the range of 17 to 27 points, that puts our short strikes at 41.60. And that's going to be the center of our butterfly position. Since we're doing a $35,000 planned capital position, we're going to sell 20 of our 4160s. We're going to buy 10 40 points higher, and in this case 4,200. We're going to buy 10 60 points lower, and in this case it's 4,100. This gives us a 60-40 broken wing butterfly position. Now, when we do this order, we're going to do it all in one order. We can put the order in as a broken wing butterfly and just fill it that way. So when we place this and we execute this order, we're going to have a position on our analytical graph that looks like this. Now, explaining the analytical graph, we have our asset price along the bottom. It's a little bit different than a price chart. We have profits and losses here up on the right side. And you'll notice that we have a triangular shaped or a sharp edged graph here. And what this is telling us is the value of our position at expiration, or the profit and loss in our position at expiration at any given price point of the SPX. So in this case here, if we came in here and we put this position on and the asset price didn't move, at expiration we would have made $20,000. Of course, the asset is going to move, and as it does, we're also going to do something called adjustments, and we'll explain those as we move along. And the other line you see here is what's called the T+0 line, and that's the estimated value of the position at any given price point as of today. That's why it's called the T, today, +0 line. So currently we entered this position. We have some execution costs. We're down $40 on entry. And over time, what tends to happen is this T+0 line gets closer and closer to the shape of our expiration graph. Now from here, the market's obviously going to move, and we'll probably, or in some cases we need to make adjustments, some cases we don't. Before we go here, notice that we are 77 days to expiration. That is our entry date. We do have a date exit on this strategy, and that is when the cycle 2-month cycles out is 77 days to expiration. So we are in July options. When our September options, so our September 17 gets 77 days to expiration, then we are going to exit. If you do the math, you can see that's what, 63 days. So if we're in this for 63 days and we don't hit our exit loss trigger, we're just going to exit the position at whatever profit and loss we happen to have. For our adjustments, we're going to adjust or make to the upside or make a positive delta adjustment if we get negative delta in the position. So this is a slightly bullishly biased position on the marketplace, and since the market typically goes up more than it goes down, and it also generally tends to do well if the market sits, and the market can go down quite a bit and we still won't hit our exit loss trigger, this does win most of the time. So that's going to be our adjustment to the upside. We go negative delta, we're going to make an upside adjustment. If the market happens to come down and we exceed our short strikes, so in this case our short strikes are at 41.60, so if at our checkpoint time the asset price is under 41.60, we're going to do what we call a rollback, and we're going to take this position and we're going to reposition it as if we're starting the position over again. So it's really a very, very simplistic strategy that works very well. Oh, and one other thing I should mention before we get going here is delta. So what is delta? Delta is the estimated number that the position will gain or lose with a $1 price movement in the asset. So right now we have a delta of positive 17.15, essentially meaning that this position, if the asset price goes up $1, is expected to gain $17.15. If it goes down $1, it's expected to lose $17.15. Now you might say to me, well, that's a little bit directional, but keep in mind over time, this is what's going to happen with our position. We're going to gain value over time, and this is going to be true whether the market goes down or the market goes up or it stays where it is. So pretty cool. Also worth noting here is our current value of the position, or the current amount of capital we have in the position, is a little over 15,000. It's probably, if you look here, the current margin is $16,340. So even though it is a $35,000 planned capital position, many times we don't get close to that much money in the position, meaning our actual effective return on actual capital tends to be much higher than the numbers we display when we talk about the profits and losses in the position. All right, so what I'm going to do is I'm going to take this day by day here, and you'll notice how the position reacts to certain price movements and so forth. Now this one here, a lot of times when we do this strategy, there are no adjustments to it. In other words, we enter the strategy, we go the whole period of time, and we don't have to do any type of adjustment, and we just collect our money. Other times there are adjustments, sometimes multiple adjustments. This is one of those a little bit more active trades, so I figured it would be a great one to display here. And lastly, I'd like to mention that we're only checking this at one time of the day. In other words, this isn't something that you're going to, a trade that you're going to do where you're going to sit here and watch the market all the time. We highly recommend not watching the marketplace when this trade is going on and picking a checkpoint time. We prefer around 3:30 in the afternoon Eastern, which is about half an hour to an hour before market close, for a checkpoint time. And you just come in, you take a look at what the strategy or where the asset price is relative to where your adjustment points are in the strategy, and you make a decision on whether to make an adjustment or not. So moving on here, if we go just 2 trading days, what happens is we get a down move in the asset price. And you'll notice that our short strikes are at 41.60, as we said earlier. The asset price is at 41.54. That is an adjustment trigger. So what we're going to do is we're going to come in here and we're simply going to close this position out. We're going to sell this broken wing butterfly, just the opposite of what we did when we got in it, and we're going to re-enter it 17 to 27 points under the money. So this is closed off. We put another order in for a 4130 60/40 broken wing butterfly, and this is our new position here. We're down about $570. Again, we have a $2,500 maximum loss, or what we call exit loss trigger, so this really isn't a problem, just a bit of a mid-trade drawdown. Let's move forward. You can see the asset price did bounce a little bit, and we've been getting that a lot, right? We've been getting these really big moves down, and then we've getting really big moves up, which has been problematic for some types of strategies, but this one's been doing very well this year. As a matter of fact, we've won every trade this year thus far, including the July trade. So let's see here. We're down 44 points this day. We're down $870, and we're still above the short strike, so nothing to do. Then we get an 83-point down move, and we end up blowing right outside the backside of the tent here. So that's a pretty big move. That's one of the bigger moves that you get in the SPX. And we're obviously due for an adjustment because we're below 4130. As a matter of fact, we're about 60 points below. So it's adjustment time. We're down about $2,000. And when we get these big down moves, we are going to stress the trade a little bit. And this is one of those situations. So let's take this. We're going to close this position out here. And we're going to go 17 to 27 points under the money. So we're going to drop down here. And we're going to go to the 40-50 options. And this here is going to be our new position. So from here, if the market stabilizes, if the market bounces, we're good. And let's take a look. Nice 65-point up move the following day. And we get a bit of a follow through. So in 2 days, we're back to break even. And this is one of the things that I absolutely love about this particular strategy. So a lot of your market neutral strategies, they call them, or positive theta or income strategies, a lot of times what they'll do is they try to maintain as flat a delta as possible. In other words, we look at this delta number here and we say, well, we want that to be very close to zero all the time. The challenge with that is when you get these big down moves, at zero delta, because of the volatility shift, and especially you get a move of that magnitude, they're going to draw down. And they're going to end up being too positive delta when you get that down move. And a lot of times what will happen is people will adjust them to flat delta again, or zero. And then when you get the bounce, like we get here, they draw down again. And that can be problematic. In other words, it's going to require the market to actually sit in a certain range for a period of time in order to make money. When we treat our trades this way, that's not so much the case anymore, as you can see. Yes, we drew down a little bit with that down move, but very, very quickly, when we get that bounce, we're right back to break even again. And most of the time, that's what the market does. Usually when it goes down a lot, it doesn't sit there. So this is perfect for these types of market conditions. So here we are. We're now 63 days to expiration. From here, let's just go to the next adjustment. So it's May 14th. And we stay in this position until June 30th. So that's literally like 45 days. We're now 16 days to expiration, and finally, you can see that what happened in the marketplace. We entered this on 430, which is here. We ended up having a very good sized down move here. We bounced that down move. This down move here didn't bother us whatsoever because we had already had a up movement in the asset price. And now we're all the way up to 42.97 with our asset price. We're up $2,500 on a position at this point. We're negative delta. We make an adjustment. So what's our upside adjustment here? Well, we want to be positive delta. We're just going to take this and we're going to move it here. That's going to put a little bit more capital in the position. It puts us to 284 for capital level. Still well below our 35,000 planned capital. If we get up towards that level, we have measures to get the capital down. But that's going to be our adjustment. And also note that September is 79 days to expiration, so we're only in this trade for another 2 days. If we go to Thursday, we get a further up move. And then if we go to Friday, we get even a bigger up move, and we end up being up about $2,515 on our exit date. And we're exiting because September's 77 days to expiration. Our July happens to be 14. Can I run this into expiration? Sure you can. Of course, you always have that risk of the market having this horrendous drop and having an issue. I wouldn't really worry about it in this particular situation. Also, sometimes there's capital considerations, and you need to get that capital into your next trade or to utilize it more effectively. But according to the guidelines, we're going to exit it here and close this position out for a profit after execution costs of approximately $2,475. Now, the question becomes, is this an anomaly? Does this only happen once in a while? And the answer is no, it's not an anomaly at all. Historically, in our back testing, in our live trading with this position, and the way we cover it in our options trading for income weekly webinars, this trading strategy wins 80 to 85% of the time. It's really a fantastic strategy. And just this year, we have now closed 7 trades for the year, and we've been positive profit and loss on every single trade this year. So this is an absolutely fantastic strategy, and I'm glad I have the opportunity to show this to you today. So that is the X4 version 17, this episode's winning trade. If you like what you see, I invite you to come on over to lockinyoursuccess.com. That's LOCKE in yoursuccess.com, or thewinningtrade.com. That's thewinningtrade.com, and discover how you too can follow along with this and many other great strategies as they unfold during our weekly options trading for income webinars within our Go membership. Also, where you can learn about upcoming winning trade presentations and get special bonus material. And perhaps best of all, remember to check out our free trading performance podcast, where you can learn to increase your trading performance regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, please make sure you comment on the videos. I answer your questions and your comments personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.